Aloha, this is Kurt Nielsen at eMortgage Hawaii, and today I want to talk about why you should start considering adjustable rate mortgages versus a 30-year fixed. So why choose an adjustable rate mortgage? It's real simple. Their rates are much lower than 30-year fixed, sometimes 1% to 1.5% lower. Now remember, ARMs are really hybrid loans. They're fixed for a certain period of time, then they adjust every 6 months or 1 year. Typical fixed periods are short as 6 months, 3 years, 5 years, and go as high as 7 to 10 years. Now, we forecast a rapid drop in U.S. mortgage rates once the Federal Reserve pushes down inflation. We hope that happens in the next 18 to 24 months. The 30-year fixed then could drop all the way back down into the 3% range. So borrowers or buyers using adjustable rate mortgages right now can enjoy a lower interest rate and treat it as a bridge loan until the fixed interest rates come down here in the next couple of years. So if you take a look at a chart of the 30-year fixed in green and the 5-year ARM in blue, you can see that over the years, the rates are typically lower. Now, right now, they're quite a bit lower. Now, I know there's a lot of disinformation about adjustable rate mortgages, but they mostly are unfounded. And I think that's the banks trying to push the 30-year fix because they get a windfall profit of getting a higher interest rate, knowing darn well that the average mortgage gets refinanced or paid off in 5 to 7 years. So they get that extra interest rate for not carrying that loan very long. Now, I remember back in 2008 when people had their negative amortization loans, which were adjustable rate mortgages, after the negative amortization period ended, they got sticker shock because the payment went up to a fully amortized payment. But that's not because the rate went up. That's just because they were paying less than the interest-only payment. And then when they had to start making the full payment, they couldn't afford it. And they should have never been in that product to begin with. So let's take an example of a couple buying a primary home, single-family residence, 760 FICO scores with a purchase price of $1.2 million and a loan amount of $900,000. So here are the different rate options. The 30-year fixed is at 5.125% today. That's August 12th, 2022. That would have a payment of $49.69. The 10-year ARM would be at 4.5 with a payment of $45.60. The 7-year ARM 4.375 with a payment of $44.94. 5-year ARM at 4.25 with a payment of $44.27. We even have a 6-month ARM at 3.75 with a monthly payment of $41.68. And you can even get that 6-month adjustable rate mortgage in an interest-only payment at 4.25, and that would have a very low payment of $31.87. So you can see the ARMs will provide a great benefit in lower interest rate, lower payments right now, while the 30-year fixed rate is much higher. So we really believe that the adjustable rate mortgages are a good product right now while we wait for the economy to respond to this inflationary situation we're in, and then hopefully get that back under control and see mortgage rates drop. If you have any other questions, please call me at 808-334-6201.